Hello everyone, my name is Ahmed Belal and today we will be presenting on a very current and fast moving topic, the evolution of US derivatives regulations with a particular focus on the crypto derivatives and the emerging discussion around the 24/7 trading. The inspiration for this topic comes from the recent discussion by the Commodity Futures Trading Commission or CFTC in 2025 and how those may reshape both the structure and behavior of derivative markets in the US. The Commodity Futures and Trading Commission, or the CFTC as we mentioned, is the main regulatory of US futures and options markets, which includes everything from oil futures to index options. The CFTC's mandate includes promoting open, transparent, competitive, and financially sound markets, as well as protecting market participants from fraud, manipulation, and abusive practices. Traditionally, the CFTC focused on agriculture, energy, and financial derivatives, but with the explosion of interest and activity of cryptocurrencies, they've had to adjust. The lines between commodities and securities have blurred, especially with products like crypto futures. This puts the CFTC in a powerful but challenging position. In April 2025, the CFTC made a major move. It withdrew two staff advisors, the number 23-07 and 18-14. These advisories had previously made it harder for exchange to list new digital asset derivatives. They required a high level of pre-listing review and approval. By removing these, the CFTC has effectively lowered the barrier to innovation. It allows more crypto-based derivatives to be listed faster as long as general listing requirements are met. This does not mean the deregulation, but a shift to more flexible principles-based approach, like what we have discussed in class with the sales certification process. It reflects growing recognition that crypto isn't a temporary trend; it's becoming a permanent fixture in the financial system. Another huge development is that the CFTC is now openly discussing the idea of 24/7 trading for derivatives, which is unprecedented. The crypto markets already operate around the clock, and the argument is that traditional markets may need to catch up. From a market access perspective, this could be huge. Imagine traders not being restricted by time zones or business hours. But from a risk management angle, it's complex. How do you manage margin calls, system outage, clearinghouse cycles, and staffing when there is no off time? Also, there is a human cost. Traders, regulators, and tech teams need to rest. It's not just a technical challenge, but a culture and organizational one. This brings up a broader question. Do we want finance to be always on? And if yes, how do we design markets for that? Institutional investors may benefit the most at first. Greater flexibility in listing new products can help hedge funds and banks create custom hedging tools. A crypto native exchange like Coinbase Derivatives or CME's Bitcoin Future Desk are likely to grow as more products come online. Retail investors will see both opportunities and risks. On one hand, more products and access. On the other hand, potential for overtrading, exposure to volatile assets, and burnout. Risk management systems at exchanges, brokers, and clearing houses will have to evolve rapidly. We could also see market liquidity increase due to more global participation. But there is a flip side. A thin trading hours could bring volatility spikes. In today's world, the digital assets are becoming a normal, not a niche. So understanding regulatory developments like this isn't just academic, it's essential for anyone planning to work in investment banking, risk management, or trading. Also, I think this is important to recognize how always on markets might affect our behavior. This can feed impulsive decisions or trading outside of rational hours. Staying updated on regulatory shifts will help to be a smarter investor and more valuable employee in the future. Even if someone doesn't really specialize in crypto, these themes, like real-time risks, market structures, and regulations, are core to all areas of finance. On a global scale, this is not just happening in the US. We are seeing major moves in other financial hubs as well. In the UK, for instance, the government helped launch the GFO-X, the first regulated crypto derivatives exchange based in London. It's backed by big names like LSEG and aims to bring institutional credibility to crypto built tradings. In the EU, the MiCA regulations, markets in crypto assets, went into force recently, giving crypto issuers and service providers a consistent regulatory framework across all member states. The takeaway is that the US isn't leading alone. It's part of a larger global wave of regulation that is trying to balance the innovation and protection. So where's this all going? Here are a few things that I think we might see next. More asset tokenization, like real estate bonds and private equity being fractionalized and traded like tokens. Better risk monitoring using AI and machine learning to manage 24/7 markets in real time. Greater global coordination among regulators. Maybe even a common standard for crypto derivatives, similar to how Basel rules apply to banking. We may also see new types of derivatives emerge that are specific to digital markets. For example, volatility derivatives for crypto or prediction markets tied to on-chain data. So, let me wrap up with key lessons from all this. First, US derivatives markets are adapting to the rise of crypto, with the CFTC taking important steps to remove unnecessary roadblocks. Second, the idea of 24/7 trading may soon move from crypto into traditional finance, with profound implications. Third, we need to understand the changes that's happening in the financial landscape, not just to pass the exams, but just to thrive in tomorrow's financial markets. And finally, staying informed is part of being responsible as an investor or an employee, and maybe one day as a decision maker. Thank you very much for your attention. I know this was a little bit a lot, but I hope it showed how relevant these regulatory changes are. Be happy to see your questions and comments. And here are the links from the CFTC for the press releases that we mentioned earlier. Thank you.